Okay, chapter 5, as it says here, is job order costing. So this is the first of 3 chapters where we dig into different ways to track costing for organizations, primarily for manufacturing organizations. In job order costing, what we're doing is tracking the costs by individual job. So you would do that if you're a company that does a lot of customized projects for clients. So you'd need to know the cost for each job that you did. Or if you tend to do things in small batches. However, companies that mass produce the same products over and over and over, they do what's called process costing. And we're going to get to that next week. Then other companies might use other approaches, which we'll get to the following week. So for this week, we're focusing on job order costing for companies that do customized work or small batches of manufacturing. I think I'll just explain as we go through. In this first exercise here, this is a manufacturer of toys, and we have to look at the costs that are listed and decide for each one, is it a product cost, meaning it has to do with manufacturing. So that's either direct labor, direct materials, or anything else related to manufacturing. Do you remember what account that goes into? Well, there are 3 product costs. There's direct materials. That's the cost of any materials that go directly into the product. There's direct labor, the cost of any labor that goes directly into the product. Everything else related to production is manufacturing overhead. So it's just this big bucket that all those extra costs go into. And then you take some of that manufacturing overhead and apply it to each job. How do you do that? We typically use 3 different cost drivers. I think we might have talked about this already. Does anybody remember me talking about 3 cost drivers? Direct labor cost could be one, direct labor hours, and machine hours. Those would be the 3 most common drivers. Does that ring any bells? A little bit, okay. So here we're just looking at, is it one of these product costs? So is it something to do with producing a product, the factory where the product is produced, a supervisor salary for the factory, something related to production? Or is it a period cost? And period costs don't have to do with production. They have to do with either sales or administration of the company, but not production. Or is it not an expense at all? Okay, so one of those 3 categories. What about this first one here? Internet provider services. Which category do you think that would be?
Period cost.
It would be a period cost. Correct. Now, if that internet provider service was only for the factory, then you might be able to argue it's a product cost. But it doesn't specify, right? So we can assume it's for the entire company. Okay. Welcome, Christina. When we get to the break, if you would remind me, I'll update the attendance. Okay, so I'm just going to abbreviate PE for period. Next, we have material expense. What do you think that would be? That would be a product cost, right? Because the materials go into the product. Raw materials inventory? Yes, however, that's a trick. That's a trick. Wait, let me think. Which one? One of these 2 is a trick. Let me think. Which one is it? Yeah, it's C. Because inventory is an asset until we've sold the product, and then it becomes an expense. So that was me. That was a trick. I didn't make it up. But this one, technically, the right answer is not an expense. If that inventory had been sold, then it would be a product cost. Okay, then we have production equipment rental. Related to production? Yes, so that's product cost. Okay, E, showroom rental.
Period.
Period, correct, because that's where you show your product, not where you make it. Factory employee salary. What was that? No, because it's a factory employee, it's still a product cost. Whether it's hourly or salary, if it has anything to do with production, even if it's indirectly related to production, it's product. Human resource director salary, on the other hand, that would be a period cost because they don't have anything to do with producing the product. Okay, any questions on this one? All right, so we had A, E, and G that were period costs. Yeah, A, E, and G were period costs. C was not an expense. B, D, and F were product. Okay, any questions? All right, so exercise number 2 here. This company makes custom professional lacrosse sticks. All right, basically what we have to do is we're going to go down the list of these different costs, and we're going to identify, is it a manufacturing cost, in other words, production related, or is it a sales and administration cost? If it is manufacturing, then we're going to specify, is it direct materials, direct labor, or overhead? Manufacturing overhead, be specific. And if it is overhead, then is it indirect materials, which is one type of overhead? Is it indirect labor or other? Okay, it sounds bad, it's not that bad. So carbon fiberglass, is that manufacturing related?
Yeah.
Yes. Okay. And is it direct materials, direct labor, or overhead? Direct materials. Okay. And since it's not overhead, we just stop there. Okay, administrative building rent. Manufacturing or sales and administration?
Sales.
Sales and administration, okay. Okay. I'll just capitalize these because it's getting on my nerves that
What
it's
was M? I'm sorry, manufacturing?
manufacturing. Yeah. Okay. Accountant's salary. The manufacturing? Okay, sales and administration. Factory building depreciation. It is, yes. Because it's depreciation on the factory. If it were depreciation on the corporate headquarters, then it would not be manufacturing. Okay, is it direct materials, direct labor, or overhead? It's overhead. And is it indirect materials, indirect labor, or other?
Other.
Other, okay. Stop me if you have questions at any point. Strings for the pocket of the lacrosse stick. It is manufacturing. Is it direct materials, direct labor, or overhead? Well, I would call it direct materials. If you have indirect materials, then that becomes overhead. So what's the fine line between them? I would say strings, we could pretty much determine how much string gets used per lacrosse stick. I think, did we have an example last week with the pizza and the spices on the pizza? Maybe that's coming up. Maybe that was in the lecture. I don't remember. Everything gets to be a blur at some point, right? If you have a material that you really can't quantify how much is being used on each product, then you just call it an indirect material cost. But strings, I think we could call direct materials. Okay, so then advertising, manufacturing or sales and administration. Sales and administration, okay. Production supervisor salary. What was that? Yes. Yep, that is manufacturing. Is it direct materials, direct labor, or overhead? Overhead, yes, correct. Because the production supervisor is not making the product, we don't count their salary as direct labor. And in fact, we would consider it indirect labor. All right. How about paint for the sticks? Is manufacturing. Now, this is also in that gray area. You might be able to call it indirect materials. I believe the correct answer, according to the textbook here, is direct materials. Might be a little hard to quantify, but we'll double check, but I'm pretty sure that's the right answer. Now, okay, this one's kind of a gray area too, research and development costs. Those can be considered part of manufacturing. I think that in this exercise, they put it in the category of sales and administration. So that's a company by company decision where you want to put those costs. The wages of the person who strings the sticks. Is that manufacturing?
Yeah.
Okay. Is it direct materials, direct labor, or overhead? Direct labor, correct. Okay, depreciation on the cutting machine. That be manufacturing? Right. Direct materials, direct labor, or overhead?
Overhead.
That's overhead, yes. And that would be other, right? Because it's not a material and it's not labor. Human resources salaries? Yes, that is an administrative cost. Okay, now factory maintenance, they're not giving us a lot to work with here. It's not labor for factory maintenance, but it is related to the factory, right? So it is manufacturing related. And since it's just kind of this nebulous category they gave us, factory maintenance, it's part of overhead. If it said, I don't know, if it gave us more details, maybe it would fall into a different category, but yeah, in general, I would say overhead. Other overhead is the best match. Okay, so those are our answers. Let's just double check and make sure everything looks right here. I think that looks like what we said. Okay. Anybody see any differences? Okay. Any questions? Okay, then on to number 3. All right, so considering the data here, welcome. First question, what is the prime cost? What goes into prime costs?
Direct materials and direct labor.
Direct materials and direct labor, okay? And we can see $2,000 for direct materials, $3,000 for direct labor. So our answer to A is $5,000. Now B says, what is the conversion cost? What goes into conversion costs?
Factory depreciation expense.
Okay, so both factory depreciation expense and the factory utilities expense are manufacturing overhead. So yes, correct, Nancy, those would be part of the manufacturing overhead. Does anything else go into conversion cost? What's that?
CU salary?
No,
Okay.
because the prime and conversion costs are only related to production, but labor is part of the conversion cost. Even though we already used it as part of prime costs, it's also part of conversion costs. So we're going to add direct labor, factory depreciation expense, and factory utilities expense. So I believe that's $7,250. Check the math here, okay? So just to elaborate on that, the prime costs are how can I say it? So if you think about the cost of making a product, primarily the materials that go into it and the labor that's involved with making it, right? There is overhead, but overhead is so many different things together that it might be a substantial part of the cost, but a lot of times a manager is just going to want to know what's the cost of materials and labor that went into this product. So they would ask for the prime costs. A big part of this chapter is going to be conversion costs. That's saying, what's the cost of taking that raw material and converting it into a finished product? And actually, that would be a big part of next week's chapter 2. So conversion costs also include direct labor and manufacturing overhead. Okay, any questions? Okay, so here we're going to see 2 versions of a formula. Here we've got a company with raw materials inventory that has a beginning balance of $200. So we know that this $200 is the beginning balance. And we can see $200 over here, so I'm going to put it on the right side as well. The company has an ending raw materials inventory balance of $300, so I'm going to put that on both sides where it says 300. The cost of materials used during the month was 900. We're going to call that materials used in production, if memory serves me correctly. Okay. And then we'll have to figure out what the other parts are. It's asking us what were the purchases made during the month. So it would make sense if we had a beginning balance of $200 and then we purchased $1,000 worth of materials, then we'd have $1,200 of materials available, right? So let's go ahead and call this $1,000 purchases. And we'll call this, I think it's materials available for use. Let me go ahead and I'll check my wording on that so I'm not throwing you off. Materials available for use, materials used in production. Okay, good. Okay. So again, we've got 2 versions of the same formula here. And the first one, this is the more common one. We're going to see this over and over and over. You take a beginning balance of inventory. In this case, it's raw materials inventory. You add to it, in this case, by purchasing more raw materials inventory. And that tells you how much you had available for use. Then if you subtract how much is left over at the end of the period, you know how much you used. A nifty thing about this is you can flip the last 2. So if you needed to figure out what your ending balance was, you could take materials available for use minus the materials that you used, and that'll give you your ending balance. Okay, so whenever you see a formula like this, where it's something minus something equals something else. Remember, you could flip the last two around. It still works. Now here's a different version. Materials used in production were $900. We had 300 left over at the end of the period. That means we must have had a total of $1,200 available of materials. And if we started with $200 worth, we must have purchased 1,000. So the second version, we're not going to see quite as often. But again, this first version, that's going to be really useful. There will be times where you'll need to use that formula to figure something out. Okay, does that all make sense? Kind of just went through it really fast. Questions? Okay. So, okay. Inventory has three different phases. First phase is raw materials. Companies buy raw materials, they keep them in a warehouse or storeroom. And then when they're ready to start making a product, they transfer those materials onto the factory floor and they start making their product. Does anybody know what we call the inventory at this stage when it's in process?
Raw materials?
Nope, not at this point. It starts as raw materials. Once it goes on the factory floor and we start to add conversion costs like labor and overhead, it becomes a work in process. So it's work in process inventory. Then once we've finished, we have those goods. What do you think we call the inventory at that point? Finished goods. Okay, there you go. So those are the three phases of inventory: raw materials, work in process, and then finished goods. So this last exercise, this one right here, we see raw materials, right? Here with work in process, we're going to see it's the same basic formula. You might be saying to yourself, it looks a little longer. It is, but it's the same basic formula. You've got your beginning inventory plus what got added during the period. That gives you the total that's available, minus your ending inventory tells you the cost of what got manufactured. So the reason this is longer is because what got added includes any additional materials, any additional direct labor, and any overhead. Okay, those are the three parts of production. So when it's a work in process, all those things can add to the costs. But it's still the same basic formula, same basic concept. So in this case, beginning balance, it says is $4,000. So that means at the beginning of the period, the costs of what they had been working on from the prior period were $4,000. That could be materials, it could be labor, it could be overhead all together. We don't really know, but we know that they had $4,000 of costs that carried over from the last period. Okay. Then they added to it $1,500 worth of materials during the period. They applied $500 of overhead. At the end of the period, their work in process inventory had gone down to $3,000 in costs, and they manufactured $7,500 worth of goods. Okay. Now we've got two things to figure out. And in this case, I think we're going to have to work backwards, because there's no way for us to know what the labor is based on this information. So if we work backwards and we say they manufactured $7,500 worth of goods, and they had another $3,000 of work in process inventory, then what were their total manufacturing costs that were incurred for that period?
4,500.
Well, good guess, but we would actually go the other way. We're going to add those together. Right, because what it's saying is we did have those costs and we had these $3,000 of costs as well, but they're just not done yet. So we had a total of 10,500. If it's helpful, you could think of it, if you were reading from top to bottom, we would be subtracting the 3,000, but since we're going backwards, we're adding it, right? 7,500 plus 3,000. Now, I mentioned earlier that these three costs, materials that were added, the labor that was added, and the overhead, that's all making up what got added during the period, right? So that's making up one thing. And we can see that, again, if we look at the basic formula, think of it like this: beginning plus whatever you added minus your ending balance, right? That's the same thing we're doing here. It's beginning plus, in this case, three different things that got added, gets us to there, minus ending inventory gets us to there. Okay? So in other words, 4,000 plus these three together gets us to 10,500. $4,000? Let's do this. We can take our 10,500, subtract the 500 in overhead, subtract the 1,500 in materials, subtract the 4,000 and beginning inventory. So our direct labor must be 4,500. So it's a little trickier here to do work in process inventory. Again, here's an alternate version of this formula. So let's plug the same numbers in here. Make sure that it all works out. Okay. So does this seem to work here? The cost of what we manufactured plus our ending inventory comes out to 10,500. We subtract from that all these other costs. We end up with our $4,500 direct labor. Okay, looks like it works. Any questions, comments, complaints? Okay. Here's a company that buys finished goods. So a company that's a retailer, they buy finished products, they resell them, right? So they don't have to deal with all these manufacturing costs. They're dealing only in finished goods inventories. So this will be simpler. This company bought $2,250 worth of merchandise. That's purchases. Cost of goods sold is 2,000. Beginning, oh no, ending inventory is 1,000. And we have to figure out beginning inventory and the cost of goods available. Okay. So again, the first one looks like the more standard formula where we're adding something and then we're subtracting ending inventory. If we were to work backwards here, what would this number be? 3,000, correct. And what would be the beginning inventory?
750.
750. Okay, good job, Marcus. So then we can transfer these numbers down here. Make sure it all works out. Cost of goods sold plus our ending inventory equals 3,000 minus our purchases gets us down to 750. Okay. Is this making sense? Okay. All right, let's move on to number 7. So now we're into overhead. This company estimates overhead will be $750,000. Okay. What is the predetermined overhead rate? Again, we've got 3 ways, 3 common ways that we can apply overhead. And a company gets to choose whatever method makes the most sense for them. So some companies, especially if they use a lot of labor, well, then there's a lot of cost for training employees, for supervising employees, overhead costs that are associated with labor. So they would probably use either labor hours or labor cost as how they're going to determine how much overhead to apply for each job. Other companies that have a lot of automation and don't need as much labor, they might find the machine hours is a better way to estimate how much overhead they should apply to each job. So a job that uses a lot of machines is going to use a lot of electricity and other overhead costs, and other jobs with less machine hours would get less overhead costs. So each company gets to make that determination. And you'd basically make that decision for the entire year. It's not like you're going to be switching between jobs or anything like that. It would be across the board. You would do it that way for the year. So did we go over the formula for how you come up with an overhead allocation rate, or is this a new concept? Must be new. Okay. So you take your estimated overhead for the year. So this company, looking at their past performance, how much they spent on overhead in previous years, and how much they're expecting to produce this year, they're thinking we're going to have $750,000 of manufacturing overhead costs. Okay. So just keep in mind, generally, if I'm talking about overhead, it's manufacturing overhead. So you have your estimated manufacturing overhead, and then estimate whatever driver you're going to use. So they could use direct labor hours as their driver, and they would need an estimate of how many direct labor hours they expect to use. They could use direct labor cost or expense, or they could use machine hours. So all we need to do in this exercise is calculate what the overhead allocation rate would be. And that's really simple. You just take your estimated overhead, divide it by your estimated driver, and you have your rate. So $750,000 of overhead divided by 60,000 direct labor hours comes out to $12.50 of overhead per direct labor hour for that company. So when they go to apply overhead to a particular job, they look at how many direct labor hours that job had, they multiply that by 1250, and that's the overhead that they apply for that job. We can do the same thing based on labor expense. So if they expect 750,000 in overhead costs, divide that by the expected labor expenses. And we come out with 0.5, so that would be 50 cents. Per, I'll just abbreviate that, direct labor dollar. So for every dollar of direct labor cost, they're going to apply 50 cents of overhead. Now, you wouldn't do both of these. You would pick one or the other, right? When we get to chapter 6, we'll have some more complex approaches to overhead where you do have multiple drivers, but here you have only one. Okay, and then if they go with machine hours, since they estimated 100,000 machine hours, you divide that into your manufacturing overhead, and that comes out to $7.50, right? Per machine hour. Okay, they would pick one of these as their overhead allocation rate, use that throughout the year. And the reason you do that is then you know for every job, you've got a reasonably accurate estimate of what the overhead costs are associated with that job. Because if you didn't do this, how would you know? How would you know how much electricity cost went to a particular job and how much supervisor salary to apply to particular jobs, right? Those things are just too hard to allocate. So this is how we do it. Okay, any questions on exercise 7? Okay, all right then, let's go on to number 8. Here we've got 3 jobs that the company is working on. We see the materials costs and we see the labor costs. So we're going to go ahead and just copy those numbers into here. A little time consuming, but you'll see it's helpful when we add them all up. Okay, so we have the materials costs and the labor costs for each job. Okay, and then we have to apply the overhead. So this company uses a rate of $1.25 for each direct labor dollar. So how would we figure out how much overhead to apply for job number 13? Multiply. What do we multiply?
The overhead by the direct labor.
Exactly. So we're going to take the $3,760 of direct labor cost times the $1.25 overhead allocation rate. And we get $4,700 of overhead. And then we can get a total for the company, for the job, 16,020. Let me know if I miscalculate here. And we can just do the same thing. We take job 14's direct labor times 1.25 to get our overhead. We add it all up. And one more time for job 15. Okay. See how those calculations look here. $16,020, $10,129, and $11,831. So I think that is all correct. Okay, does that make sense?
You multiply overhead $1.25 times direct labor.
Right, times the direct labor cost, because that's the driver that this company uses. If they were using direct labor hours, we would need to multiply the rate by the direct labor hours, which they didn't even give us in this case because we didn't need them. Or if they were using machine hours, we'd multiply the rate by the machine hours. Any other questions? Okay, number 9 then. Okay. So this company's only had 2 jobs. And job 10 has been completed. Job 20 is still in production. They should have just called them job 1 and job 2, right? If they've only had 2 jobs. Okay. We see job 10's information here. That's the one that's completed. We see job 20 over here. That's the one that's still in production. And question A says, what is the balance in work in process? So what's the total cost of their work in process inventory? Did you say 2608? Okay. It's 2608, right? Because job 20 is still in process. So that is the cost of the work in process inventory. We can see the material costs that have gone into that job, the labor costs that have gone into that job, and the manufacturing overhead. Now, usually you don't add your manufacturing overhead until the job's done. But for some reason, we're told it's still in production. So that means 2,608 is the work in process inventory. Okay, so what is the balance in finished goods inventory?
2,400.
That would be 2,400, correct, because that job is done. Okay. Now, if manufacturing overhead is applied on the basis of direct labor hours, that was one of the 3 options, right? So this company, if they're using direct labor hours to apply overhead, then what is their predetermined overhead rate? How could we figure that out?
The number of hours divided by the total cost.
Okay, you're on the right track. So the number of hours is the direct labor hours. That's definitely going to be part of our calculation. What do we know? We know the direct labor hours for each job. We know the manufacturing overhead cost that's been allocated to each job, right? Can we work backwards to get the rate? How would we do that?
Is it dividing direct labor total cost by direct labor hours?
That would give us the direct labor rate, like what we pay the workers. So you're close. You're close, but what we need is the overhead allocation rate. Is that humming noise? With these speakers?
Is it the camera?
Oh, it's a computer.
Is it total cost divided by direct labor total cost?
You're still close, but that's not quite it. We're trying to figure out the overhead allocation rate, right? Nan, you got it? The manufacturing overhead divided by what?
Labor hours.
Yes, yes, correct. That'll do it. So let's take a look at that. Excuse me. So for example, in job 10, it was $60 of manufacturing overhead. And that was based on 75 direct labor hours, right? So if we take that $60 divided by the 75 direct labor hours, we get 80 cents of overhead per direct labor hour. And to check it, because it should be the same for every job, let's look at job 20. We had $90 of manufacturing overhead. Divide by 113 direct labor hours. Okay, it's a little bit of a rounding difference, but you can see it's also 80 cents, right? Okay, so now we know the answer. It's 80 cents per direct labor hour. Okay, does that make sense? Okay. Let's see. We knock out maybe 2 more exercises and then we'll take a break. Does that sound good? Okay. Let's see. This company was working on job 1 and job 2. Okay, there were $780 in direct materials costs. That's between the 2 jobs. 375 of that was for job 1. Okay. And what we need to do here is basically fill in what's what. So we see that $375 right here, right? So that's direct materials. And since we know, okay, guess I closed my calculator, but that's okay. Still here. We know there were $780 in material costs total. 375 went to job 1, $405 then was for job 2, right? So we can see that this $405 down here is direct materials for job 2. It says then direct labor costs, including payroll taxes, comes out to $23 per hour. Okay. Employees work 18 hours on job 1, 29 hours on job 2. So on job 1, we see 18 hours here in 2 different places. And on job 2, we see 29 hours in 2 different places. So which of these is direct labor? 18 hours at a rate of $23 per hour is 414. So this must be our direct labor, right? And down here, 29 hours at $23 per hour. That is the 667. So this makes sense, right? They're doing direct material, then direct labor. This must be the manufacturing overhead. Why would it have 18 hours though? What does that signify? So here it says overhead is applied at the rate of $20 per direct labor hour. So for job 1, they're taking the 18 direct labor hours times the $20 overhead allocation rate to get their overhead cost. Make sense? Down here, we've got 29 direct labor hours times the $20 overhead allocation rate, again, to get our overhead cost. So how would we label the bottom line? Total cost, okay. Okay, so now we see the cost breakdown for both jobs. Does that make sense? Okay. All right, well, let's move on to number 11 then. Trying to fit that on one page. Okay, give up like that. Okay. The question here is, what is the cost assigned to job 5? So we've got these transactions here. The company purchased $1,000 of raw materials inventory, but it doesn't say that they applied any of that to this particular job, right? Here, they did assign $500 to job 5. So we'll put $500 of raw materials. Then we've got 20 hours of payroll at $1,000. That's been assigned to job 5. Factory utility bills of $750. Okay, it doesn't say it's been assigned to this job, right? It just says that we have these bills. So this is how overhead works. All these costs that are not direct materials or direct labor, they just get recorded as part of manufacturing overhead. Then when you finish a job, you take some of that manufacturing overhead using your overhead allocation rate, and you apply it to your job, right? So at this point, these utility bills, that's just a general expense for production. Down here, though, we apply overhead at $10 per hour. Back here, it said it was 20 hours of labor. 10 times 20, that's 200. So it looks like our total for this job is 1,700. You got your direct materials, your direct labor, and the applied overhead. And yep, 1,700. Okay. Any questions? All right. Well, let's go ahead and take a 10-minute break then. We'll pick it up from there. Okay, so let's pick it up here with exercise 12. Got a company that it says uses specialized machinery, 450 machine hours. They have incurred $500 in utilities costs, $300 in factory depreciation, $100 in property tax, and we need to prepare journal entries, okay? First, we need to journalize these expenses. So, any guess where this 500 in utilities goes in this journal entry?
Accounts payable?
It would be accounts payable, correct. When you get a bill from a utility company, you can record the expense at that time, but typically you don't necessarily pay it immediately, so it becomes an account payable. Now, in financial accounting, you would have debited utilities expense. But here, it's just going into that manufacturing overhead bucket. So all three of these costs, the utilities, the depreciation, and property tax, we're just putting it all under manufacturing overhead as one big debit. You might remember in financial accounting, when you had depreciation, you would debit depreciation expense, credit accumulated depreciation. Well, here we still credit accumulated depreciation, $300 in this case, but again, the debit is going to go into manufacturing overhead. Same thing with our property taxes. Going to be credit to property taxes payable. Just going to add all three of these up, $900. Debit to manufacturing overhead. Okay. So I like to think of manufacturing overhead as this big bucket that all these manufacturing costs go into, except for direct labor and direct materials. And then when we complete each job, it's kind of like we take a ladle based on our overhead allocation rate, and we apportion some of that cost of manufacturing overhead to that particular job. Okay, so A is complete. B, record the allocation of overhead at the predetermined rate of $1.50 per machine hours. So how many machine hours did we have? 450. Okay, so we take the $1.50 rate times the 450 machine hours, and we get $675. So this is the ladle that I was referring to. We're taking it out of manufacturing overhead and putting it into work in process for that particular job. Right. Part A, we were putting those costs into manufacturing overhead. In part B, we're taking them out, putting them into work in process. And this work in process inventory account is for that specific job. Okay, are we ready for 13? This job was completed at a cost of $5,000. Okay. Then there's another job completed at a cost of $3,000 and also sold. Okay. So first we have to journalize the completion of job 113. Now, a lot of times, if you look at the notes in the journal entry, it kind of gives you a hint. So we're transferring this job to finished goods inventory, which makes sense, right? If it's finished, we would transfer it to finished goods inventory. But where are we transferring it from? Yes, work in process. Remember those three inventory stages? It goes from raw materials to work in process to finished goods. So that's what we're doing here, transferring it into finished goods. Now, when job 85 is complete, it's going to be the same thing. So I'm just going to copy these. And again, it's going from work in process inventory for job 85 into finished goods inventory. However, that job also gets sold. So you see, when it's sold, it comes out of finished goods inventory. That's when that inventory becomes an expense. What do we call that expense? Cost of goods sold. What would be the amount? What was the cost of job 85?
3,000.
3,000? Okay. Yes. All right, that was the cost that was transferred from work in process inventory to finished goods inventory. So when it's sold, it would be the same cost getting transferred from finished goods inventory to cost of goods sold. Now, when we make a sale, what are the other two accounts that we need to include in the journal entry? In this case, we're told the sale was made on account. So what do we call that? If the customer didn't pay us, but they're going to pay us later? Close. Accounts receivable. Yeah. If we owe the money, then it's accounts payable. If we're going to receive the money, then it's accounts receivable. And what would be the other account? That'll come later when they make the payment.
Oh,
At this point, we just made the sale. So we need some sort of revenue. Typically, it's going to be sales revenue. Sometimes it might just be sales. Let's take a look and see what they called it here. Oh, here we are. They just called it sales. So either is fine. Okay. So when you have a sale, assuming you're using the perpetual inventory method, which is the more common method, you're going to have the amount of revenue, either cash or accounts receivable. You're going to have the cost of goods sold. If you're a retailer, you would probably have merchandise inventory, but because we're a manufacturer, it's finished goods inventory because we had to, get it to that point. We had to go all the way from raw materials to work in process to finished goods. And now we made the sale. Okay, questions? Answers? Anyone have any answers? Okay, going on to number 14 then. We've got 3 jobs. This is similar to the one we did before. They give us the direct material and direct labor costs. So we're going to do the same thing. We're going to apply the overhead and the totals. We're also going to total the rows. It's nice when you're totaling columns and totaling the rows, because then you could check. If you get a different answer in your total for the column than you do horizontally, then you know there's a mistake somewhere. And then we're going to do some journal entries. Okay, let's just go ahead and plug these numbers in, starting with the direct materials and direct labor. Okay. Again, we're using a 1.25 allocation rate for overhead based on direct labor cost. Just like we did before, we'll take the cost of the direct labor times 1.25. I better check. Sometimes they like to round off. I think they're rounding on this one. They are rounding. Okay, again, let me know if you get any different numbers than my numbers. We're going to round this one up. Oops. Round that one up to 3,593. Okay, and then we can do our rows. Of course, if you use Excel, you could, set up a formula. It would be a lot faster. Okay, so if I add the last column, 32,337. We add the bottom row horizontally here. I also get 32,337, so that looks right. And it matches this as well. Okay, so those are our totals. Any questions there? Now we do our journal entry. So for B, we need to record the assignment of direct materials to work in process. Okay, we see the total direct materials cost here, 14,883. It's going into work in process inventory. Now, it is kind of weird that they're taking 3 jobs and then doing 1 journal entry for all the raw materials. I would probably do it as 3 separate journal entries. But who am I to argue? So where is that coming from? Which account? Again, oftentimes you can find a clue in the note.
Oh,
Yeah, so this would be the raw materials inventory account. For C, we're transferring direct labor into work in process. It's coming out, well, it's going into work in process inventory. They're probably calling this factory wages payable. We'll confirm all of this. And the last one is manufacturing overhead. So it's coming out of work in process inventory. It's going into work in process inventory from manufacturing overhead. Overhead. Okay. Let's check that. Raw materials inventory for A, factory wages payable for B, or I'm sorry, raw materials inventory for B, factory wages payable for C, manufacturing overhead for D. Okay. So in other words, these were costs of raw materials inventory that the company had purchased. Materials were just sitting there waiting to be used. Once they got assigned to these jobs, then accounting transfers them out of raw materials inventory into work in process. Same thing when we've got these wages that we know we're going to have to pay these employees for. We put that under work in process for those particular jobs. And when the jobs are done and we know how much manufacturing overhead to apply based on our overhead allocation rates, we take that out of manufacturing overhead and apply it to work in process. Okay. We move on to 15. Okay, we've got some more journal entries here. This will be our last exercise. So here we've got 4 different jobs. We see the materials costs associated with those 4 jobs. We see the labor for those 4 jobs and how much overhead has been applied. We also see not job specific materials and labor. What do we normally call the not job specific part? You have, for example, material costs that don't go directly into a particular product. We call it indirect materials, right? And labor costs that don't go directly into a particular product, we call that indirect labor. So that's what we see down here. This might be materials that got wasted, maybe it was scrap material. Could also be like if your factory workers had to do some training, that's not directly related to making the product, so that's going to be indirect labor cost. So that's what we see down here, indirect materials and indirect labor. A says prepare an entry to record the assignment of direct material to work in process. So that's kind of what we did in the last one. We're moving into work in process inventory. Where's it coming from? The raw materials inventory. Now, why is it $1,489? So the total materials costs minus the indirect materials. In other words, if you just add up the direct materials cost, it's $1,489. Because the indirect materials cost is going to go into manufacturing overhead. Okay, part B, we assign direct labor to work in process. So again, they debit to work in process inventory. And they're probably calling it factory wages payable. This 940 represents the direct labor costs without the indirect labor. And then overhead is only applied at the end of the job. So it's always gonna, there's no direct or indirect. It's like overhead costs, and then they get applied. So all of these overhead costs are going into work in process inventory, coming out of manufacturing overhead. And let's check that here. Okay, yeah, that all looks good. So we're done with the exercise set. Any questions here before we move on to the problem set? Okay. All right, we're going to start with problems 2, 3, and 4. For 2, so this company is a machine shop. So what does a machine shop do? They work with metals typically, right? I think I've never worked on a machine shop. I think they have machines that work with metal, like drill and mold and that kind of stuff. So this is a machine shop. They have estimated overhead of $50,000. And they've estimated 5,000 hours of direct labor. The cost for job 325 is $70 in aluminum. 2 hours of labor at $20 per hour. Then they've got some indirect material costs, administrative labor, utilities, and depreciation. Okay. First question, what is the predetermined overhead rate if direct labor hours are considered the cost driver? Remember that formula to come up with your overhead allocation rate? Yep. So what do we divide? What was that answer?
By labor hours.
The estimated overhead by the labor hours, right? Okay, so we have $50,000 of overhead divided by 5,000 direct labor hours, and that comes out to $10, right, per direct labor hour. Everybody agree? Part B says, what is the cost of this job? Okay. Well, let's break that down. That would be direct materials, direct labor, manufacturing overhead. So how much is our direct materials cost?
$70.
Okay, the only material they specify here is the aluminum. So $70 in direct materials. How about direct labor?
$40.
Okay, and how'd you get that, Marcus?
You multiply the 2 hours by $20 an hour.
Okay, that's exactly right. There were 2 hours of labor at $20 each. One thing you just have to remember about labor is they'll often give you the number of hours and the rate separately, and you just have to multiply. Okay, and what is our manufacturing overhead for this job?
$750.
So that is the overhead cost that the company incurred, but it's not necessarily for this job. In fact, I think you've answered question C, right? Because if we take the indirect material cost at 50 plus the administrative labor, which in this case, what they mean is administrative labor in the factory. So it's still production related. Plus the utilities, plus the depreciation expense, that would be $750. So the overhead costs incurred for the month are $750. But what were the overhead costs applied to this particular job? Got it?
Is it estimated overhead by hours?
Well, that gave us our $10 overhead allocation rate, right? We took the $50,000 of overhead divided by the $5,000, 5,000 hours of direct labor, and we got our overhead allocation rate, which we can use to apply for this job. But how much should we apply? $10 per direct labor hour. Okay. How many direct labor hours were there? Two. So we just take the $10, we multiply it by the 2 hours, and we get, oops, I'll put it down here, $20. Okay. Now, if we add up these three costs, we get $130, right? That is the cost of that job. Okay, yep, $130. Does that make sense to everybody? So with overhead, you have to first get your rate, which is estimated overhead divided by your estimated activity. Then for each job, you take that activity, multiply by the rate to get how much overhead to apply. In this case, there were 2 hours of labor for that job. So we take that activity of 2 hours of labor times our $10 rate. And that's where we got the $20 of applied manufacturing overhead. All right, let's move on to number 3. Okay, this company expects $900,000 in overhead, so that's their estimate. They're not sure if they should use direct labor hours. They're estimating at 60,000, or machine hours, which they're estimating at 30,000. And again, it's up to the company, but really what they should go with is whatever gives the best allocation of overhead. I mean, if they actually do have $900,000 of overhead, then really the question is how much gets applied to each job, right? That's what they're trying to work out. It's kind of, I used this example with my other class last week. It's kind of like if you and your spouse have auto insurance together, and they'll ask you, how many miles are you going to drive and how many miles is your spouse going to drive? And they just want to have a rough idea so they could figure out, where to apply the expenses. But it's going to come out to basically the same. And you could shift it around, but it's still the same number of hours. Same thing here. It's the same overhead. We're just saying how much of it's going to go to this job and how much is going to go to that job. So we'll go ahead and go through this process. We'll look at the two options. What if they use direct material as their driver? Direct labor as their driver. And what if they use machine hours? And then the company could make a decision after doing this analysis. So for this particular job that they are using as an example, there are $1,550 of materials costs. So we're going to put that in both columns because that's going to be the same regardless of their overhead allocation rate. Same thing with their labor. They have 90 direct labor hours for this particular job. And their labor rate is $16 per hour. So we take 90 hours times $16 an hour. Labor comes out to $1,440. That is the same in both scenarios. The only thing that's changing is how much overhead to apply to the job. If they go with labor as their driver of overhead, it's $15 per hour. Right? Because you take $900,000 in overhead, divide by the 60,000 estimated labor hours, you get $15 per hour. And for this job, oh yeah, it said 90 direct labor hours, right? So 90 times the overhead allocation rate. That would be overhead of $1,350 if they use labor hours as the driver. Let's add that up. And we get a total cost of $4,340 for that job. Well, now we want to compare that with what if they use machine hours as their driver for overhead. Well, it says machine hours, they would apply $30 per machine hour for overhead. Where's that coming from? It's the estimated overhead divided by the 30,000 machine hours. That's where they get $30 of overhead per machine hour. So then it says here that this job uses 75 machine hours. So how would we calculate our overhead for this job if we use machine hours? Yep, $30 per machine hour times 75 machine hours. 30 times 75, we get 2,250. That's quite a bit more than if we had based it on direct labor hours. Yeah, almost double. So let's go ahead and add that all up, get a total cost for that product. 240, let's check my calculations. Okay, came out right this time. So, which approach did they use? Now that they've done this analysis and compared this job under both circumstances, did they go with labor hours or machine hours? Was that?
Labor, because it's cheaper.
Yeah, labor is cheaper, but remember, they're gonna have the same overhead costs either way, they're just dividing it amongst their different jobs, right? So maybe that's the right answer. Again, the question is, which one is a better representation of their overhead costs for the job? If this job, uses a lot of machine hours, it would make sense, it would have high overhead associated with machine hours. If it uses a lot of labor compared to other jobs, then why is the overhead, what did I say, labor head? Why is the overhead rate so low? So there is no right or wrong answer. They'd have to take this into the context of their whole production, all of their jobs together to figure out which it seems to be the more accurate way to allocate the overhead to the job. Or another way to say that is, where are these overhead costs coming from? A lot of it is electricity costs or machine maintenance costs. Then you probably want to go with machine hours. If it's coming from supervisor costs, training costs, maybe labor hours is more appropriate. But we didn't actually have to make that determination for this problem. I just wanted to throw that in there. Any questions on how we did these calculations here? Okay. Number 4 is a doozy. Yeah, this one used to always throw me off. I think kind of finally got the hang of it. The reason it's confusing is just the way that they lay out the data. We've got 4 different jobs. You can see those listed over here. It shows us the costs for each job each month. What's a little confusing is that it's cumulative. So this first job had $2,500 of costs in January and then another $1,200 in February. Right, so at this point, they've actually had $3,700 in costs. So that makes it a little confusing. Also, you could see each job gets completed in a particular month and gets sold or doesn't get sold at a certain time. So based on all this information, we have to figure out what is our work in process in each month. In other words, what are the work in process costs at the end of each month? What are the finished goods costs at the end of each month? And what are the cost of goods sold costs at the end of each month? Okay. So let's just go through it together and figure it out. And the only way I've been able to do this is just one step at a time. Okay. Don't have any shortcuts. So let's just start here with January. We have $2,500 of costs for this first job. Is this job in process? We know it must be, right? Because this job continues into February. So that means it is in process in January. Everybody agree with that?
Mm-hmm.
Okay. So we could put that here. But let's see if we have any other work in process in January. This one, it actually shows gets completed in January. Okay, so that's going to go under finished goods. In fact, let's go ahead and put it there. Finished goods for January. And that's it. That's all that was going on in January. How about work in process in February? This first job here, it says it was completed in February, right? So that's finished goods. What is the cost of that job that got finished in February? This first job. Yes, but remember it's cumulative, so it's actually 3,700,
Oh.
right? So this first job that got completed in February, $3,700 of cost. But this job also gets completed in February, right? That's another 3,250. We need to add those together. Okay. Then we have this $3,409 in February. That is a work in process, right? That one doesn't get completed till April. So this 3,409 is work in process in February. Any questions so far? Okay, let's look at work in process for March.
Oh, I do have a question.
Yes.
Why did you use, the work in process for January also? And then you combined it?
Yes, because this is one job. So in January, there were $2,500 of costs for that job. And then there were another $1,200 of costs for that job in February. So that means the total cost of those finished goods is $3,700. Make sense?
Yeah.
Okay, so let's look at work in process for March. This first job is completed in February. Next one's completed in January. This one's completed in February. The only job that was in process in March was this one. Oh, actually, we have $3,409 of costs from February plus $2,319 for March for that same job. So we need to add those together, which looks like 5,728. Okay, so I think we finished the work in process column. Finished goods, we got January and February. Do we have any jobs? We don't have any jobs getting finished in March, do we? Oh, we don't, but this first job that got completed in February never got sold. So it's still a finished good in March. Yeah. See, we had $25 of work in process costs plus another $1,200. So that's $3,700 for that job when it's finished. It's still a finished good in March because it hasn't been sold.
It was never completed,
What's that?
but it wasn't complete. It wasn't completed in February.
It was completed in February, so it is a finished good.
It just like rolls over.
Yeah, it's still sitting on the shelf. It's still finished goods inventory until it gets sold. So we do have 3,700 of finished goods in March. Okay, I think we got it right so far. Let's go on to cost of goods sold. What got sold in January? Only one, right? This is the only one that got, oh no, actually, sold is over here. Nothing was sold in January. So there's zero cost of goods sold in January. What got sold in February? Only this 4,838. What got sold in March? Only this 3,250. Confusing, right? There's probably an easier way to solve this problem. I'm sure if you made some sort of a fancy spreadsheet or something, it could do the calculations, but I think we got it right. So let's check. Okay, so we have 2,500, 3,409, 5728. That's good. 48, 38, 69, 50, 3,700. That looks good. 48, 38, 32, 50. Okay, and that looks good. Any questions on what we just did? The only problem like that, so you're not going to have to solve one like that on your own. That would be mean. For some of these problems, when I first tried to understand what was going on, I had the answers and I still couldn't figure out what was going on. Okay, so we did 2, 3, and 4. Let's see what's next. 7, 8, and 12 and 14. Okay, oh, it's 752. Let me just take a quick peek at these. Okay. I think maybe, would you be okay with maybe we'll take a 5-minute break now? Then we'll come back and knock out these final 4 problems. Okay, let's do that. So take a 5-minute break, come back at 7:58. And we'll be finishing up early this evening. Ready? Problem 7. Okay, so we've got a whole bunch of data here. We have to calculate cost of goods manufactured, and overhead is based on direct labor hours. Okay. So the first thing we need is the overhead rate. Here they call it predetermined overhead rate. It's the same as the overhead allocation rate. It's the rate that we're using to apply overhead. So if it's based on direct labor hours, what is it? Okay, so the 23,500 is the direct labor hours incurred. So those are actual direct labor hours. What was our formula to come up with our overhead allocation rate? Estimated overhead divided by our estimated activity, right? Because you're setting this rate before the year has started. You're working with estimates. What's our estimated overhead? 270,000. What is our estimated direct labor hours? 24,000, right? And so if we divide, we get 1125. So that is our predetermined overhead rate. Then, as the year progresses and we actually have direct labor hours, then we multiply by the overhead allocation rate. So how much would we have applied in overhead for the entire year? We take this rate and we multiply it by the actual direct labor hours, which is the 23,500. So we would have actually applied $264,375 of overhead. So think of overhead in three different varieties. You've got your estimate of your overhead, which is before the year starts. It's how much you think you're going to have an overhead cost for the following year. And that's what you use to come up with your rate. Then you take that rate during the year and you actually apply it to your jobs. So by the end of the year, you've got a certain amount of overhead you've applied. But then at the end of that year, you can also total up your actual overhead costs. So we have these three varieties: estimated overhead, applied overhead, and actual overhead. Why do we do it that way? Well, by having the estimate, we know how much to apply throughout the year, so we have a rough idea of what our overhead costs are for each job. And then we can compare that with the actual overhead once we know what it really is for the end of the year. Okay. So here we know our overhead allocation rate, which was based on the estimates, and we know how much we actually applied during the year. Then we can proceed here. Remember this formula? We've got beginning inventory plus what we added minus ending inventory. So that's what we're doing here for raw materials. Beginning inventory is 30,000. Purchases, raw materials purchased is 350,000. We can add those together and we had $380,000 worth of raw materials available. Then at the end of the year, we had $28,000 worth of raw materials that we hadn't used. So that means we must have used the difference, right? So we added the purchases, subtracted the ending inventory. Okay. This materials used in production is part of our work in process inventory, right? Because it went from raw materials into production. What was our beginning work in process inventory? It was 51,000. Our ending work in process inventory, I'm going to go ahead and put down here, that was 67,000. Now remember, with work in process inventory, we're adding not only materials, we're also adding labor and overhead, right? So let's see how much direct labor costs we added. That's direct labor cost is $85,000. And then overhead applied, we already calculated that, remember? That was this 264,375 from up here. So now if we take the beginning inventory, so this is how much cost we had at the beginning of the period for whatever was already in process. These were costs from the last period, and that inventory was not complete yet. So it stayed in our ending work in process inventory. And once this new period started, it became our beginning work in process inventory. So we take those costs, we add our new materials, new labor, new overhead from this period. And then that gives us our total manufacturing costs for this period. Which I calculate to 752,375. Okay. So again, you could think of it like this: beginning plus materials, labor, and applied overhead gives us our manufacturing costs incurred. Then what do we do with our ending inventory? Subtract it. Exactly. And that gives us the cost of the goods that we manufactured, also known as finished goods inventory. Oops. There it is. Okay, so that's the cost of the goods that we finished manufacturing in this period. Does this make sense? Yeah, okay. And I said we would do 8 next. Are we ready to move on, or are there any questions on 7? Move on? Okay. Okay, this one looks easy. It's actually tricky. So let's see what's going on here. This company estimated annual overhead to be $85,000. That was based on a predetermined overhead rate. Wait. Oh, I'm sorry. No, it based its predetermined overhead rate on 24,286 direct labor hours. So in other words, its estimated overhead was 85,000. Estimated direct labor hours was this number. Now the actual overhead was 90,000. And their actual direct labor hours were 24,100. So remember I mentioned to you, we have to estimate overhead so we can come up with a rate. Then we apply overhead throughout the year. So we can total that up and see what is our total applied overhead. And then we can compare that with our actual overhead costs. And basically always going to be different, right? So your applied overhead is always going to be either over applied or under applied when you compare it with the actual overhead cost. So we have to compare the actual, which it says is $90,000, with the applied overhead. So the estimate was 85,000. The actual was 90,000. How do we figure out the applied overhead for the year? You have it, James?
Actual minus estimate?
Nope. No, nice guess. It'd be nice if that were the case, but it's not that easy, unfortunately. Well, let's break it down. In order to apply the overhead throughout the year, they need a rate, right? They would need an overhead application rate. What is our rate in this case?
4,286 direct labor hours.
Okay. That's our estimated direct labor hours. How do we get our overhead allocation rate? Divided by I like what you're thinking. Kind of moving in the right direction here. All right. Let's think of it this way. I'll tell you what, let's color code this a little bit. This part up here is all estimate, right? You know what I'll do? I'll underline it. Those are estimates. Right? And these two down here, these are actuals. What we have to figure out is how much overhead was applied. And how do we apply overhead? Well, we come up with an overhead allocation rate, and then we multiply that by the activity. What was the formula for the overhead allocation rate? Okay, so the estimated overhead divided by, in this case, the direct labor hours. So that would be 85,000 divided by 24,286, right? Oops. Try that again. $85,000 of estimated overhead divided by 24,286 direct labor hours. We'll round that off to $3.50. Okay. Oops, $3.50 per direct labor hour. So that is our overhead allocation rate. Then throughout the year, we would multiply that by the direct labor hours that have happened for every job. But now that we're doing it after the fact, to get the total, we could take the actual direct labor hours that happened throughout the year, multiply it by our rate, and that will give us our applied overhead. Does that make sense? $84,350 is our applied overhead. In the examples we had earlier, we were working on one job at a time, right? We'd have to figure out what is our overhead allocation rate based on the estimates. We'd apply it for that particular job, right? We'd multiply the overhead allocation rate times whatever was the activity. The only difference here is we're doing the whole year's worth of activity at one time to get a total applied overhead. And it comes out to this 84,350. So you see the company estimated their overhead to be 85,000. Then during the year, they applied 84,350. And then when they added up to see how much overhead they actually had, the actual was 90,000. So now to figure out, did we over apply or did we under apply? We compare our applied overhead to our actual overhead. So which is it? Did we over apply or under apply? We under applied, right? Because the amount we applied was less than the actual. In fact, the difference, we take $90,000 of actual overhead minus what we applied, the difference of 5,650. So then to fix that, we don't go into each job individually, that'd be too much work, but we do have to update our records. So because we had under applied overhead, sounds backwards, doesn't it? You can also over apply overhead. But basically what it means is we need to increase our cost of goods sold. We did not apply enough overhead costs into our cost of goods sold. So now we need to add that. So we're going to increase our cost of goods sold. Where does that come from? It comes out of the manufacturing overhead. So what do you think we would do differently for our journal entry if we had over applied? We'd have to flip it, right? We'd be reducing cost of goods sold, so we'd have to credit that, bless you. And we would be increasing manufacturing overhead to fix that. Okay? Questions? No? Okay. All right, so we're done with that one. That's our answer. Let's move on to number 12. 12 and 14 are both journal entries. Be a lot of scrolling on this one, kind of hard to avoid. Okay. Okay, we've got all these transactions and we need to journalize them. The first one, we buy some raw materials on account. What would we debit? What would we credit? We bought some raw materials on accounts.
Inventory.
Okay, we're going to debit raw materials inventory because that's what we got from this transaction. And assets we debit when they go up. And what would we credit? Oh, so close.
Accounts payable.
Yes, accounts payable, right? Because we have to pay for it. Okay. Okay, so that's the first transaction. Next transaction, we're applying some of those raw materials to a particular job. Okay, so then we're taking it out of raw materials inventory. That gets the credit. And do you remember where it goes? Work in process. Inventory. Okay, so it's coming out of raw materials into that particular job's work in process inventory. C, we've got some raw materials that are used as indirect materials. And so that's also coming out of raw materials inventory, but where does it go? Indirect materials, also known as manufacturing overhead, right? That big bucket of manufacturing overhead is everything other than direct materials and direct labor. So it includes the indirect materials. Then we've got direct labor for this job. So again, they usually call that factory wages payable. And if it's direct, it goes into work in process inventory. For E, there's some more labor, but it's indirect, so it's going into manufacturing overhead. Let me check on that. Sometimes they change the wording, so. Well. Okay, factory wages payable is correct. Any questions so far? Okay, so F. Factory utilities incurred on accounts. Remember how we journalized that? Going to be a debit to manufacturing overhead. Credit to accounts payable. Next, we've got some depreciation. How do we journalize depreciation in the manufacturing environment? It's also going to be a debit to manufacturing overhead. Credit to, getting late, right? Accumulated depreciation. It might be helpful just to remember everything that's not going into work in process inventory, going into manufacturing overhead. Except for that first purchase. Okay, then we go to H. H is applying manufacturing overhead as 200% of the direct labor cost. Okay. So direct labor was this $300. So we're applying the manufacturing overhead to this particular job at a rate of $600 total. So this is where we're taking out of manufacturing overhead, putting it into work in process inventory for this job. Okay, then we have to figure out the total cost for this job so we can transfer it to finished goods. We had the 500 in raw materials, 300 in direct labor, and 600 in overhead, right? So this is just for us to add those up. 500 in direct materials, 300 direct labor, 600 in manufacturing overhead gives us total cost of $1,400 for this job. How do we transfer it to finished goods inventory? What would be our journal entry? So we're going to debit finished goods inventory. Where's it coming from? Work in process. Okay. If it helps, remember that the inventory moves from raw materials into work in process. You add your conversion costs, your labor and your overhead, and then you transfer it to finished goods. Then when you sell it, it becomes cost of goods sold, right? So what we're doing here is we're moving it from that job, now that it's done, into finished goods inventory. And what is J? I think we sold it. We sold it for $3,000. Okay. So we've got 4 accounts here. How are we going to journalize this sale? Okay. So this bottom one here for 3,000. Going to be sales, oops, sales or sales revenue, either way. This is probably going to be accounts receivable, unless the customer paid cash. And what about these two? Remember, we had previously transferred the job out of work in process inventory to finished goods. Now that we sold it, it goes from finished goods to where? Cost of goods sold, yeah. Cost of goods sold. Okay. Coming out of finished goods inventory into cost of goods sold. So that's what our sale looks like. And then for the last part, we were $100 over applied in manufacturing overhead for the year. So if we were over applied, that means we applied too much overhead to cost of goods sold. So we need to reduce our cost of goods sold. We would do that with a credit. And what would we debit? If we over applied manufacturing overhead and we now have to fix it, what do we debit? Manufacturing overhead, all right. Because when we apply it, we're taking out of manufacturing overhead, going into work in process, and it eventually ends up in cost of goods sold. So to correct it, we're shifting between manufacturing overhead and cost of goods sold. And so this is what it looks like if you over applied. Okay, any questions on this problem? Right, well, let's move on to our final problem. In this case, it's the same concepts, but the terminology is going to be a little different because this is for a movie. So it's not a physical, tangible product that's being made. Instead, it's a movie production. So again, the concepts are the same. Here are a bunch of transactions, and we're going to need to journalize them. The first one, we buy some supplies on account. Actually, that part is exactly the same. It would be a debit to supplies and credit to what? Accounts receivable or payable? Payable, correct. Okay. For B, we issued some of those supplies to a particular movie. So instead of work in process, we're calling it movie in process. That sounds a lot more fun than a work in process. And so that is coming out of supplies. Okay. We're saying these supplies have been allocated to this particular movie. Then for C, we've got some indirect supplies. That's also coming out of supplies. But because they're indirect, just like indirect materials and indirect labor, we're putting it into overhead. And since this is a movie, we're calling it movie overhead. I will tell you when you go to do the problem set in Canvas, there are going to be 2 debits to movie overhead. In this problem, there are going to be 2 credits to movie overhead. So pay attention to the wording, because in Canvas, it's going to ask you for the final debit to manufacturing overhead. That would be the second one. And it's also going to ask you for the final credit to movie overhead. Did I say manufacturing? Anyways, you get the idea. So make sure you use the final one in each case. Okay, questions? D says we have some time tickets showing direct labor for $32 million. Wow. Must be one of those Marvel movies, right? Okay, so what do they call this? I think they call it salaries payable. Check, I think that's what they call it. Salary payable. Okay. I don't know why, but they're calling it salary payable. Again, companies have a little bit of discretion exactly what names they give to their accounts. So salary payable, and that was, I think, for this particular movie. Yes, it says it's direct labor. So we're going to call that movie overhead. Then we've got some indirect labor. I'm sorry. That should have been movie in process. Right? Because that's direct labor. Indirect goes to movie overhead and also is a credit to salary payable. Yeah, so just like with physical products, if it's directly related, it goes into the in-process account. If it's not, it goes into the overhead account. Then we get to F. We have a utilities expense on account. Remember, utilities just go into overhead. And since it's on account, we credit accounts payable. Then overhead is applied at a rate of 10% of the direct labor costs. So they're taking it out of movie overhead and going into movie in process. Like that. Now, the textbook actually says for service-based companies, use operating overhead. So this one's kind of an exception, but that would be a general term. For a service-based company, operating overhead would be your overhead account. Yep. Okay, so the other problems you'll get to work on your own. We went through, I think, the hardest one. So hopefully if you get stuck on something, you'll find an exercise or a problem that's similar. But of course, you could always reach out to me if you need any help. Any questions before we wrap it up? All right, well, looks like we're finishing early this evening. So have a good week, everybody.